Yes, ma'am.
Thanks a lot. So, today we are going to talk about overview of wealth management. What we're going to touch on, last time that I conducted the lecture, we touched about overview of investment banking. And we said in investment banking, you have many branches, right? You have pure investment banking. And then investment banking also touches on stockbroking services as well as asset management services. So this is kind of what we're going to touch on today, but we're going to look at it a little bit more broadly in terms of wealth management services, which is slightly different than when you talk about asset management. So we'll come to asset management, but we'll first talk about what do we mean by wealth management and why that's important and what type of clients we are trying to cater to when we talk about wealth management. And then we'll come to specific asset management, how it gets done. Please feel free to ask questions. I can't see your questions because I'm sharing my screen. So feel free to ask any questions that you have um, as when I'm going along the lecture. Let me see if I can log in through another device so that I can see any chat questions that you all enter as well. Okay. So, what do you mean by wealth management and how does it differ from asset management? When you think about wealth management, here you're looking at definitely when you think about wealth management, I'm sure you're thinking about giving a financial service. And it is that. It is providing financial advisory services for larger investors who we call accredited investors and other investors with high net worth. And when we say wealth managers provide advice about investing. It's true, but it's not just about investing. If you're talking about true wealth management, and we don't really have proper full service wealth management that I have seen um, in Sri Lanka, because if you're talking about wealth management, you're not just talking about investing. You're talking about estate planning, tax planning, anything essentially that can help a client grow their wealth. So, what do we mean by that? Here we're talking about, um, the client getting, for example, investment management advice. And this is the easiest type of wealth management that is there, right? Not the easiest, but this is the most common type of wealth management that is there. Because when you talk about wealth management, we would immediately think, okay, we are helping the client invest their assets in different places. So this is the most common thing that comes into our head. But wealth management is not just that. It's also about providing clients additional services, like, for example, accounting and even tax services, uh, legal planning, estate planning. Essentially, we'll talk about it in a little bit, and then even thinking about charitable giving plans where they can contribute to society, providing them with options to provide charitable contributions is another area of wealth management. You might be surprised to think that providing them with charitable giving plans is an area of wealth management, but it is. Of course, charitable giving plans you don't see as popular in Sri Lanka, but it has become very popular in places like the US because if you think about charitable giving plans, this is also places where you can try to optimize your taxes. So you are contributing to the society, but also optimizing your taxes. So this is a place where wealth management can come in and help the client achieve two things at the same time, right? Kill two birds from the same stone, so to say. Even like looking at their different social security benefits in terms of their insurance, health plans, uh, life insurance covers, all of these fall into um, wealth management, helping them start a business. So let's just take it one by one, right? Because you can really amalgamate different types of services. When you think of wealth management, I'll break it down into three big components. One is investment planning. This is the area that we have heard about. Investment planning means you take your client's portfolio and you manage it for them. So this can be in different ways, or different service levels can be provided in terms of managing your client's portfolio for them. But investment planning essentially means that here, when you manage your client's portfolio, it's not just about you know selecting the correct assets and investing in the correct assets, but also about being able to provide the correct documentation, like, for example, performance reporting, being able to model the cash flows for them. What do you mean by modeling cash flows? What you're trying to do here is to forecast what are the possible cash flows that the client will incur over their lifetime, over whatever the period that the client has given his portfolio for you to manage, or the client's objective. Right? So sometimes the client might give you a portfolio to be managed for 5 years or 3 years, but he has a longer term objective. So when you're managing the portfolio, you have to think about, okay, what are the cash flows that he will incur through his lifetime? So it could be that, for example, uh, he will obviously have his day-to-day expenses, but part of that cash flow can be managed through his salary. But in addition to those, he might want additional. So, for example, maybe he wants to take a trip every year. Maybe he wants to save for his kids to go to college, for their marriage. You want to save for your retirement. So, you would want to look at all the different cash flows that the client will incur over their lifetime when you want to do a true full wealth management service. Think about ways to increase and accumulate your assets. Obviously, this means you're trying to figure out, okay, what assets that I want to invest in. Do I want to invest in shares or bonds or anything else, real estate, gold, and how much? What is the allocation that I want to invest in each of these assets? So we talk a little bit about investment planning side, but what I want to show is, when you say investment planning, you're not just thinking about portfolio management. You're really looking at a client's, what will the client need? So what is their, cash flow? You model their cash flows. You look at their retirement income planning. Then even life event funding goals. Life event funding goals were like what I mentioned, wanting to send your kids to college, which is a very expensive endeavor these days, especially with the rupee depreciating, all the expenses increasing, inflation. So you have life events. Maybe it's the client's marriage. Maybe it's him buying a house, him or her buying a house, right? So there are different life event goals that clients will have. Maybe it's saving for their retirement. But for all of these, the plan should be different. The way you plan should be different. And I'll talk about why and how it can be different later on. But you understand that you have to think of it in different ways. So this is one aspect of wealth management, and it is the most known and common aspect. But if you think about things that we don't usually see, especially in countries like Sri Lanka, advanced planning. Advanced planning means things like, now you get to the next level of wealth management, estate planning coordination. Estate planning essentially is trying to manage your wealth upon death, right? So you're trying to manage your estate. So here you try to make sure that all your assets are safeguarded in case of something happening to you. How is your asset safeguarded? How does it get transferred to your children or to wherever you want to transfer it to, right? So the client can do it themselves, or you as a wealth manager can help them do it. So for these, you will obviously need specialized people. So you would need to recruit specialized people who would be able to, for example, lawyers, who would be able to take your client through estate planning processes, tax lawyers for tax coordination processes, you know, business planning, succession planning, how to mitigate other risks. These are all things that you will look at when you think about this concept of advanced planning. So that's the next layer, if you will, right? Because we all know, okay, fine. There's sometimes the client will give you a portfolio and say, manage this portfolio for me. Or the client will come and say, I have 100 million rupees or I have 200 million rupees. What do you think? Where should I invest? How will you invest? And manage it for me, manage the money for me. So you will think about what is your target, what do you want to achieve, how do you increase it, and you'll try to manage the money for them. That part you will do in investment planning. That part, if you do comprehensively, you'll talk to the client, try to identify their goals, try to identify their requirements. What are they saving for? What are their cash flows like? And you'll try to help them through that process and then invest. But if you go to the next step is more advanced, right? And it's more advanced to the fact that now you're looking at not just managing the portfolio, but what are the tax consequences of all these investments that I am making? Are there any other tax consequences that come to the client? Are there ways of mitigating these tax consequences to the client? When this portfolio, how does it translate to the next person, the next generation, right? For example, in the case of the client's death, what happens to the portfolio? Is the portfolio safeguarded? Is it cordoned off? And does the client have a last will and testament, right? And can he transfer it? Or do we need to help him out in this regard? These are things that you will talk with the client and work with the client in terms of advanced planning. And then life plan. And when we talk about life planning, here we're talking about intergenerational needs. Moving your portfolio and keeping your wealth and preserving your wealth or growing your wealth through generations. Intergenerational planning. Estate planning is about what you do on death, but intergenerational planning is about not just growing your portfolio for your retirement. It's about growing your portfolio so that your sons and daughters can also benefit from it. It's about growing your portfolio in case, for example, if you have special needs children. How do you create a legacy for them where, in case something happens to you, they have a portfolio that is cordoned off, that belongs to them, that is growing, that will work even if you are not around? Philanthropic opportunities. This is again comes back to charitable giving. Philanthropic opportunities or charitable giving is essentially about contributing back to the society. And it's also about taking advantage of, for example, if you can do philanthropy, you can contribute back to the society, but also in the meantime, also get an advantage in terms of the way that your taxes are calculated. Then that's something that a wealth manager should definitely look into and advise the client on. So when we think about wealth management, what I keep on trying to say is, we generally think about investments, growing investments, right? In terms of banking products, we think about, okay, when we say wealth management, how do we offer better banking solutions in terms of, higher rates in fixed deposits, better rates in loans, better solutions to the client, right? But we don't think of the next step. And if you really think about it, wealth management is all encompassing. It's about, catering to these high net worth individuals who might have more complex situations, complex in terms of portfolios, complex in terms of tax situations, who may have a different situation than your regular customer. So how do you cater to that, and how do you get these clients to stay with you because by staying these clients, especially going on to intergenerational needs-based planning, there is something that's a way for you to capture the client and for them to stay with you even after the client passes on, right? Even after he retires or he passes on, right? So these are ways that you capture the next generation as well. So it's beneficial to both the client as well as the firm or the bank that's engaging in this assignment. Any questions? Okay. So what really is the difference between wealth management and asset management? What do you mean when we talk about wealth management and asset management? Wealth management is much more broadly focused than asset management. Asset management is a part of wealth management. You saw this here, right? Wealth management is all of these areas combined. Asset management is just only this component of it, right? So it's more narrowly focused. Wealth management concerns about your taxes, your assets, estates, trusts, all of these things, right? Versus asset management is about what to buy. It's about, whether you should be investing in stocks, bonds, real estate, cash, what to buy, what to sell. Should I hold? Should I trade? Asset management focuses more on developing a portfolio and managing that portfolio. So wealth management is mainly for individuals and families, while asset management can be for anybody. You can have companies that have asset management, but you don't do wealth management for companies. So, as you can see, asset management is available in some form for everybody. Wealth management is much more exclusive. It's usually there for high net worths, for you to capture that high net worth market. So, when you think about products offered in wealth management, especially when you think about banks, for example, offering wealth management, you don't just think about your core banking type products. This is necessary. You have to offer clients beneficial interest rates on their FDs, right? You offer them current accounts, savings accounts, FDs, special rates, better service. All of this is super important. But also lending products, not just a core banking type like fixed deposit investment solutions, right? You're talking about lending products in terms of not just loans, housing loans, not just that, margin lending, credit cards, all of these different services that you have. But in addition, stockbroking services, share trading advisory services, this is something that you can offer your client. So where if you can offer within your bank or your company that's offering wealth management services, if you can offer the client the option of advisory for share trading or means of share trading, right? And then insurance products for not just, right? So usually you would see that most banks would offer life insurance policies. Most banks would work together with insurance companies to offer life insurance policies. But it's not just about that. There's a whole gamut of insurance products that you can help your clients with, right? So for example, you have life insurance, health insurance. What about for your house, right? So property, health, life, all of these can have different types of insurance policies. And then you can offer them asset management services, which is anyway a basic part and parcel of wealth management services. Ways of, structuring trusts, tax lawyers. So all of these different things that we talked about. And in addition, sometimes you might have seen some banks do this. They offer concierge services, right? Concierge services, like for example, here we see a lot of banks offering, like for example, restaurant bookings, theater tickets, maybe some stay at a hotel, things like this, right? Something additional for the client. In addition, you can offer them, like for example, if they want to buy or sell real estate, helping them, because you would have access as part of a wealth management team, you would have access to another large base of other high net worth clients who are looking to either buy or sell property themselves. So you would know better than your client probably who are the other people who these types of investments would be suitable for. So helping your client in terms of real estate location, um, helping your client in terms of art or gold or whatever storage. These are different types of concierge services also that banks offer or wealth management companies offer to their clients. Questions? Okay. If you have questions or chat, just let me remind you that I can't see the chat at the moment. Okay. So, when you think about what or how to offer wealth management, you're thinking about different levels of service. It can range from the most basic level of service that a bank or wealth management company can offer to much more advanced services. So your service level offerings, we can start from, let's say, for example, custodian type services to up to discretionary. So if I divide it into 4 categories, right, you will have custodian services. Your customer can give you an execution only mandate or an advisory mandate or a discretionary mandate. So your wealth management, the type of service you will offer your customer or the type of service your customer will want from you as a fund management or wealth management company or as a bank, right, will differ. So you know that certain banks offer custodial services. This is also part of wealth management services. Custodial services, in a way, are one of the most basic parts of wealth management services. What does custodian do? What does a custodian do? What do you think? Yeah. Any examples? Anybody who's working in custodian divisions that are currently here? What do custodians do? So you have banks that offer custodian services, right? Custodian, just like the name implies, is a person who holds in safekeeping. Custodian is a person who holds in safekeeping. So, what do you mean by providing custodian services or custodial services? Here, what you're saying is you hold clients' assets in safekeeping. This usually involves, uh, certainly in Sri Lanka, this usually involves shares, bonds, maybe other investments, like, for example, FDs that clients have invested in terms of different banks or different finance companies. So the certificates for FDs, commercial paper, securitized paper. Remember we talked about these last time. So holding in safekeeping these different types of assets or ownership to assets. That's what a custodian does. So what do they do? When a client wants to invest somewhere and they, let's say, for example, a client goes and invests in shares. Who holds the share portfolio? It can be held through a custodian bank. The client can have their own share portfolio directly through an individual stockbroker, or they can hold a share portfolio through a custodian bank. Now, in Sri Lanka, if you hold a share portfolio through a custodian bank, you can pretty much trade with any stockbroker. Otherwise, for a client, what happens is, if you have a custodian portfolio, if you have a share portfolio that you're holding individually with a broker, for every single broker that you want to trade with, you have to hold a separate portfolio. So if you want to trade with broker A, you have to open a portfolio, you have to open an account with broker A. If you want to trade with broker B, you have to open an account with broker B. Okay. Like this, for every broker that you want to trade with, that has a quantity that you want to buy or sell and you want to deal, you will have to open separate accounts with each of these brokers. Unlike if you have a custodian portfolio, all of these brokers can transact one stop through the custodian. So you don't have to have a separate account with each stockbroker. Imagine how convenient that is for clients. Right? So custodian banks offer services like this. They will also help you in safekeeping. Let's say, for example, your bond portfolios. So your bonds or bills that you want to buy can be kept. The security can be transferred to the custodian bank and held on your behalf. When you want to invest in a FD or a commercial paper or a securitized paper, you will get a certificate to your hands, right? You can keep it with the custodian for safekeeping, so that at any point you don't have to maintain, the client doesn't have to maintain files themselves. They can keep all these different information with the custodian. So the custodian's job is, one is safekeeping, making sure that all records are kept, collecting the income as and when these assets mature, dispersing the funds when the client wants to, and making sure that you report everything and keep a record of everything together. So this is a basic type of service that this is the most basic type of wealth management service, but this is certainly a part of wealth management services because it really makes the client's life easy in terms of trying to make sure that everything is in one place. So it helps in terms of accumulation or aggregation of wealth. Some clients might give your fund manager or your wealth management company or your private banking arm execution-only mandates. Execution-only mandates, just like the word says, means that the client will sign a contract with you, ask you to manage his portfolio, but it's not really managing his portfolio, it's executing what he wants to do. What does that mean? He will direct which shares to buy, which shares to sell. He will direct which deposits to invest in, right? You will simply do the paperwork and documentation for him. So let's say, for example, the client says, I want to buy John Keel's shares, right? The fund manager will have to buy, now client says, I want to buy 1 million John Keel's shares. So the fund manager can look around and figure out who has John Keel's shares, who's the broker that can offer 1 million shares quantity of John Keel's, right? So they will recommend to the client, okay, this guy has this much of shares and they are willing to sell at this price. So that type of thing the fund manager will do, right? So they will select the brokers to execute, for example, the transaction. They will do security transactions on behalf of clients, but the client directs where to invest. The fund manager has no say in where to invest. It's simply that the client will direct where to invest, but the fund manager will execute that investment in the best execution manner. You will find the stockbroker who can do the transaction, for example, without disturbing the market. He will find, if you want to buy a bond, he will find, okay, what are the rates that are there prevailing in the market, and the client says, okay, buy me a 10-year bond. He will talk to other dealers in the market and figure out what are the best rates that are available and tell the client, you can deal through this dealer. He is offering the best rate for you. So the fund manager will do that coordination part. He will also probably do the documentation part, where he will, when the client says, I want to invest in this securitized paper, or I want to invest in this commercial paper, the fund manager will do the documentation part for you, or that company will do the documentation part for you, where they will, put your details in and do that investment on your behalf. These are execution only mandates. There's no investment advice. It's the client directs you what to do. Versus advisory mandates, now you're taking it one step higher. In advisory mandate, you are advising the client. As a fund management company, you're advising now the client how to invest, what to invest, where to invest. But in an advisory mandate, it's still up to the client to decide what they want to do, how they want to invest, and where they want to invest, right? So, for example, in an advisory mandate, it might be that the fund manager will look around. So the fund manager decides. Let's say, for example, the fund manager decides, okay, I want to allocate 50% of this client's portfolio to bonds, 25% to the share market, 25% to fixed deposits. Okay. So the fund manager says, okay, I am advising you that this is the best asset allocation, and these are the reasons that I'm advising you. I think right now bonds are going to do better than shares. So let's put 50% of your, because interest rates are going to go like this. Interest rates are going to move like this. Okay. So let's put 50% of your money, let's invest that in long-term bonds. Let's invest 25% in the market, because the share market is also going to do okay. And we are estimating that you will get this type of return. And we're recommending that you invest in these types of stocks. But ultimately, it's up to the client to say yes or no. So here now the fund manager is doing a lot more work, right? Advisory means that they are going to be advising on the investment strategy. But still, on an advisory mandate, the client will still make the final decision. The client will counter back and say, maybe, but I'm not comfortable investing so much in bonds. I take your point that this is a good company to invest, but I want to invest in this company, right? Ultimately, the final say is still with the client. So the highest level of service offering comes with discretionary mandate. Usually when you think about a fund management company or an asset management company, most fund management companies advise their clients based on discretionary mandates, right? Not all. You have a lot of fund management companies that do execution only mandates and advisory mandates, where the client still does the work, or the client still makes the decision. But what happens, the fund manager or the wealth manager essentially recommends where to invest, looks around for rates, hunts around for opportunities, and recommend. Once you make the recommendation, the client will choose whether to invest or not. In a discretionary mandate, it's not like that. The fund manager or the wealth manager has sole authority in what assets to buy, what assets to sell, how much assets to buy, where to invest, what is the allocation. Of course, it's not like they are going to do it all on their own without talking to the client. The client will be informed. You will have regular client meetings. But now, in a discretionary mandate, the fund manager will decide. So the client always, it's his money, so he always has the right to override the fund manager. He has the right to override the fund manager. But in general, you are happy to accept the fund manager's advice and accept where the fund manager wants to invest for you. You've given authority to the fund manager to make decisions on your behalf. Any questions? Quiet class. So generally in a discretionary mandate, when we talk about discretionary mandates, in even not just discretionary, but mostly indiscretionary. Even if you think about an advisory mandate, this will be true. The first thing that you will do is you will start off by constructing what we call an investment policy statement for a client. If you want to do wealth management for clients, and as you go up the ladder, the very first thing that you do, other than for execution mandates and for custodian clients, where you're simply safe keeping assets on behalf of your client, other than for that, you will first and foremost try to understand the client's needs. So you need to thoroughly understand what are my clients, what does my client want and why does my client want it. And not just what do they want, everybody wants to get rich, right? It's not about just what does my client want. Can they afford to want it? Right. And why does my client want? How much time does he have to get the type of returns that he wants? These are all things that you have to try to figure out. You know that cash flow modeling I was talking to you about? This is where you start to do it. So you start off, the first point when you do a discretionary mandate is starting off by creating a comprehensive IPS for your client. And an IPS gets better the more wealth that you manage of your client. If you're only managing a small portion of your client's wealth and not a comprehensive wealth manager, then you don't get to see the entire gamut of what the client has. So you can't create a comprehensive IPS for your client, right? But the more wealth that you manage of your client, the better you can cater to your client in terms of trying to manage their, like I said, intergenerational needs, trying to manage their retirement planning, their life goals. So trying to manage all of that becomes easier and better the more portfolio that you manage of the client. So what do we mean by an IPS? And how do we develop an IPS? An investment policy statement essentially means it's simply a document that documents what your client wants and what are the constraints in achieving it. Yes. And this is a very important starting point, and in most jurisdictions, it is mandated that you have an investment policy statement for a client. Even now, I believe the new SEC rules that have been drafted for investment managers mandates that you have, it's not written as investment policy statement, but you have a document that includes these criteria. Right? So, what are these criteria? The first part that we try to understand of a client is what are his objectives. And then we try to see what are the constraints in achieving these objectives. So the two big objectives that you have are the return objective and the risk. What is the return the client wants and how much risk is he willing to take? These are the two big things that you try to do or you try to understand about your client. Return, it's not easy. It's not easy to understand either of these objectives, but not understanding them will create big problems. Okay. Now, for example, when you say return, it's very difficult to quantify what is the return a client wants. Any client, if you ask them, they will want the maximum return. How do you quantify that to what is the return that you're happy with? That's a very difficult thing, and that's something that you should come to with talking to the client, having many multiple discussions with the client, trying to understand. Because you should, at the end of your discussions, be able to specify that return objective and specify a measure of return. Your client wants to invest in the share market and achieve the share market return. What is this client's desired return? What does he want to achieve? To come up with the return objective, you really have to see what does he want to achieve. Is he saving, for example, for retirement? Is he saving for his kids? Is he saving to buy a house? You're required, so why are you investing? Trying to figure out the goals of what you're trying to do with this investment helps you come up with what's a good return benchmark and what's a good return objective for this client. Because different clients will have different return objectives. And this is true whether you're a high net worth client where you're trying to manage a client's wealth, or whether you're an institutional client, for example, a pension fund or a society, whatever type of client you are, whether you're an institutional client or a high net worth wealth management type client, trying to understand what your objective is of why you're trying to save or invest will help you figure out how much and where you need to save or invest. So when achieving the return objective, you have to try to figure out what is this client's goals. I mean, you will always ask the client, what are the returns that you need? The client will not always, but most probably tell you returns that are very difficult to achieve, right? So, not impossible, but they won't give you the easiest targets, right? So, difficult to achieve. But if you figure out, okay, this is why you're saving, this is what you're trying to do, then you can come up with a more realistic goal of and try to make the client understand why this goal is realistic. So it could be this is the money that the client keeps solely for investment purposes. He just wants this money to grow. He has other money which he's saving for a rainy day. He has other money which he's saving for retirement. But this money that he is giving to you to manage may be just purely for investment purposes where he's willing to take on higher risk and get it to grow. Or it could be that he wants you to manage his money in such a way that he's saving for his retirement, and or maybe saving to send his son or daughter to university somewhere abroad. So these are things that you have to figure out, and then you have to then look at, okay, you're saving for your retirement. How much money would you want in retirement? What is your lifestyle now, for example? How much money are you spending now? Okay, 200,000 to 250,000 is your average spend for a household. And then you think, okay, this money is going to grow, or at least your inflation is going to be there. So if you're spending about 200 to 250,000 now, probably with the level of inflation, maybe this money, the amount that you spend will keep on going up. And probably you're going to retire, this client who's come to you is going to retire in another 30 years or another 20 years. And based on the retirement, by the time he retires, how much would his spending patterns look like? What? Based on those spending patterns, how much would he need to save? How much money would he need to have by the time he retires? And based on how much money he would need to have by the time he retires, how much money would he need to save? What type of return would he need to achieve to get to that goal? Now you come to your return. What is a probable return that is required to make sure that your client achieves that goal? That is probably where the return objective will fall. So now you know what your return objective is, right? Even harder is to figure out your risk. Whose risk? The client's risk. What risk is the client willing to take? Because you have to understand there are two components of risk. Risk can be defined into ability to take risk and willingness to take risk. A lot of people, especially when you talk about rich clients, high net worth, where you're trying to offer them wealth management services, they have ability to take risk. This is not their only money. They have other money, probably, right? So ability to take risk sometimes is there. Not to every client, but to probably this gamut of clients that you're trying to get into, ability to take risk is probably there. But is the client willing? And that's a very qualitative factor that's very difficult to define, because clients themselves, they don't understand how much risk they're willing to take. If I ask you, you wouldn't understand how much risk you're willing to take, how much money you're willing to lose. You know, these days the stock market is going up, right? I think you all would have seen a lot of the time share market is moving up. If you look from the beginning of the year to now, share market has moved up about roughly 66%. So that means on average, if you invested in all the shares in the market, if you invested 100,000 rupees, you would have 166,000 rupees in your hands, not doing anything, right? If you put your money in a fixed deposit at the beginning of the year when rates were low, you would probably have accruing interest at 5%. You invest in the market is giving you potential returns of 66%. If you take another index, like for example, the S&P/SL 20, which talks about the 20 largest, most liquid stocks in the Sri Lankan stock market, that's gone up about 46%. So if you had ₹1,000,000 and you invested in these 20 stocks, you would have ₹1.5 million by now. You would have a near 15% return from investing. So this is the time a lot of people start to come to the market. This is the time people see, okay, the market is doing really well. I should be going and investing in the market. You know, I should be buying stocks because everything I buy, you know, pretty much turns to gold. So this is the time you see a lot of people start to come into the market. The problem is we don't buy the entire market, right? In Sri Lanka, we have 288 stocks or 290 stocks in our share market. Do we go and buy all 290 stocks? We don't. We buy a dozen stocks, maybe 20, maybe 10 shares, right? So some of the stocks that we pick are going to give negative returns. Some of the shares that we pick will give positive returns. And all the shares that we pick are not going to give 50, 60, 100% returns. Some will give negative 10, 20, 30, 50% returns. So, how much risk are you willing to take? How much money are you willing to lose? What do you mean by negative 10, 20, 30, 50% returns? You put in 100,000 rupees, negative 50% return means you're taking home 50,000 rupees. You've lost 50,000 rupees. You put in 10 million rupees, you've lost 5 million rupees. But that's the type of risk that you're taking when you put your money in the share market. Does your client understand that? Can he tolerate that type of risk? Because you have to understand, risk is the possibility of your returns not being what you want them to be. You want to get positive returns. You're seeing these massive positive returns, right? And you invest in a company thinking that you're going to get a certain type of return. But there is risk. There is risk that the return will be negative. There is probability that the return will be positive, but very small positive. Maybe you get a 2% return, and you could have invested in a bank fixed deposit at the beginning of the year and got a 5% return. That's the risk that you're taking when you invest in different types of assets. There's always a probability that you get a 100% positive return. and double your money. But clients tend to see the upside, they don't tend to see the downside. Very difficult for client to understand how you can lose money and to figure out how much money he can tolerate to lose. So you have to specify that measure of risk as well. How much volatility are you willing to take? You have to try to figure out, and it's the most difficult thing to figure out, because if you ask clients, you say, "Oh, no, I don't mind. Don't worry. Do go and invest in the share market. I don't mind losing some money." But when you actually lose money, then all hell will break loose. So because of this, and that can happen because you're not buying the entire market. Even today, if you take any number of people, you will see some people would have lost a lot of money in the share market, despite the fact that the market is going up and has gone up 66% year to date. It depends on the type of stocks they have chosen, on the time that they entered the market, or at what point did you come in and buy the shares? Did you buy them at their peak? So all of these different factors will impact your return. So to understand a client's ability, there are many tests that you can do, right? So there are small questionnaires that have been developed by many researchers that try to identify the client's willingness to take risk. Because ability to take risk is easy to quantify. Ability to take risk is the fact that how big is the portfolio your client has given for you to manage versus his entire wealth. If the portfolio that you're managing is a big portion of his entire wealth, then you should be very careful that you don't make sure that you're not going to be gambling away, or not gambling is the wrong word to use, but you're not going to be using your client's money in ways that are excessive risk, because you don't want to lose too much because you're pretty much managing most of his money. Versus there can be a 100 million, or a billion rupee client could have given you 100 million rupees to manage, because he wants a portion managed in bonds and bills and shares that he's not very familiar with. That investment portion, maybe he can take on higher risk. So ability to take risk depends on the amount of money that the client has given for you to manage, the objective of why the client has given you to manage that money, and the size of the amount of money that is given for you to manage relative to his entire portfolio. What do you mean by objective of why he's given you to manage the money? That, also age, client's age, and employment. These are other things that will determine the client's ability to take risk. So the objective of why has he given you the money to manage, it could be an investment objective. This is simply money that the client wants to invest and grow. It has no particular meaning other than to grow his wealth. So he's willing to take on higher risk for this money to grow this money. But if this is money for him to send his children to school abroad in 10 years' time, then you don't want to take on excessive risk and lose a portion of that money. The client's age matters. Because if the client is saving for retirement and he's right now 50 years old and he has a few more years to retire, then his ability to take risk comes down. If the client is 20 years old and he's giving you money to manage for his retirement, then the client's ability to take risk goes up. His employment status matters. His employment status meaning, is he fully employed at a place that's paying, that he's getting a salaried income? If he's getting a salaried income, his ability to take risk is higher than if his business owner who is probably even making more than a salaried employee, but the income is volatile. If the income is volatile, you need to make sure that a portion of income that he's setting for investment purposes is not volatile. Because that portion of income should be able to get him steady returns to complement his monthly needs. So ability can be quantified by looking at many different factors. Willingness is a little bit more difficult. Somebody trying to ask a question or any questions that you have? Okay. So the third thing that you look at with clients is what are their constraints. Once I know my client's return and risk objectives, then I have to look at factors that will limit their investment options, limit the places where they can invest. Some common things that will limit their or constrain them is liquidity, time horizon, tax or regulatory matters, and any other unique considerations. So for example, liquidity means how much liquidity does this client need? How much money can he afford to put for long term? And how much money does he need to keep short term to pull out? So for example, if a client wants to get a regular monthly income from the money that he's investing, the amount of liquidity that he needs to keep, ready cash that he needs to keep to get this regular monthly income is a little bit more higher. He can't afford very high volatility in his portfolio, right? Versus if the client doesn't want to touch this money for the next 5 years, the type of risk that he can take and the places where he can invest are very different. So how much liquidity does the client want? Is this portfolio money that he will need very soon in the future? Or is this money that he will need for some time? Because the longer you keep your money, the more options there are to grow your money. But if you need liquidity, then your option universe reduces. Time horizon. Time horizon means, again, it's kind of overlapping. The concepts are kind of overlapping. Time horizon means how long are you investing for? For what reason are you investing for? Right? Like I said, are you a 50-year-old investing for retirement, or are you a 20-year-old investing for retirement? This will change the way I create a portfolio for you. A 50-year-old investing for retirement can't take a lot of volatility in his portfolio, can't take a lot of risk. Because if you lose money, there's not a lot of time for you to gain that loss back. Because portfolios anyway move up, come down, move up, come down. So even if you lose money in the long term, you're still going to be okay, right? So if you look at, for example, stock market performance over long periods of time, we observe that over short periods of time, like a period of 1 year, there is higher probability of making losses. But the longer you hold it, the probability of making loss comes down quite drastically. So if you hold your portfolio in shares for over 10 years, 99% of the time, for example, you probably won't be making losses in your portfolio. Your portfolio will still give you positive values. Right? Versus if you want to invest in the stock market for 1 year, then the probability of you making losses as well as high returns, but the probability of you making losses are higher. So the amount of volatility that you can take in a portfolio changes with the amount of time that you can keep it invested. Because the problem is, it's not that in a 10-year portfolio you're not making losses, but in a 10-year portfolio you might make massive losses, but you have time to recover. Okay. So time horizon becomes very important consideration in terms of where you can invest and what type of risk you can take. tax considerations, regulatory considerations, these are other things that you will look at for sure for a client. You know, is this client in the higher income bracket, lower income bracket? Will doing certain things push him to the higher income bracket? These are things that you should be looking at. And other unique considerations. Other unique considerations include things like, for example, now some clients might want to be investing in ethical stocks, for example. Ethical shares where they say don't go and invest in let's say companies that are producing alcohol or tobacco or things like that. I want you to invest in ethical shares. Right? There can be clients that are investing only in Sharia compliant shares. There can be clients who don't, who are averse to investing in long-term fixed deposits or long-term, sorry, not fixed deposits, long-term fixed income instruments. Different unique considerations because of different requirements by clients. These are things that you have to take into consideration. There might be some clients, another unique consideration that you might have is, especially with these big clients, they might be in boards of certain companies. So they might say, don't invest in companies which I am a board member of. I'm a board member of, let's say, John Keel's Commercial Bank and Cargill's. So don't go and invest in these three shares. That's a unique consideration to the client. But that's something that you have to keep in mind because some of these shares might be the shares that are doing well. And by not being able to invest in them, the portfolio might not perform the best way that it could. Right? So these are different considerations that you have to keep in mind when you're developing an IPS. So ultimately, taking the risk return objectives into consideration, taking the investment constraints into consideration, you put up a document. And this document is very important to make sure that the client understands what you're going to do and you understand what you're going to do as a fund manager or a wealth manager. You understand what you're going to do and both of you have the same expectations about what needs to be done and where it needs to be invested. So this is the starting point, the investment policy statement. Questions? Okay. So you can see this is the same thing that I've drawn here. Essentially the same thing. You put together the investment policy statement by taking into account risk, return, liquidity, time horizon, taxation, unique considerations, all of these. Draw up the investment policy statement. Once you understand the client, you can look at all of these different factors and come up with the client's ideal asset allocation. What is this client's ideal asset allocation? Remember, what do you mean by asset allocation? Asset allocation means not what shares you're going to buy. Asset allocation means what type of assets are you going to buy for this client? Are you going to buy shares and bonds and commercial paper? Or are you going to buy shares only? Or is the majority of your assets, of your money going to be invested in bonds? So your asset allocation tries to define how much money are you going to invest in each type of instrument. So how much money in equity? How much money in fixed income? Within fixed income, how much money in short term? How much money in long term? How much money in government securities? How much money in corporate debt? How much money in real estate, gold, anything else that the client is thinking of investing in. This is what I mean by formulating the asset allocation strategy. So generally what a fund management company or a wealth management company, when they have a discretionary portfolio or an advisory mandate, What they will do is they will create this investment policy statement, understand their client's need for wealth, and figure out what are their restricted parameters. After they do that, they will then, I mean, this is a continuous part of it. This is not per client that they will do. Then already they have a process where they've also tried to understand what is the operating environment. Right? Now, in any fund management company, you will see that you will have an idea about how do you think the stock market is going to perform? How do you think interest rates are going to perform? How do you think exchange rates are going to perform? And based on these different, how do you think the economy is going to perform? And based on these different factors, you come up with a conclusion or a thesis about, do you think the stock market this year is going to do well? Do you think the bond market this year is going to do well? Interest rates are going to come down, go up. If it comes down, then, it's the time to buy bonds. If it's going up, then, we shouldn't be buying bonds, but we should be investing in long-term, fixing our investments long-term. So these are different things that we will have a thesis of. A fund management company will have a thesis of. They will analyze the operating environment, analyze interest rates, exchange rates, credit growth, economic growth, right? They will analyze all these different factors, understand that operating environment, and figure out which direction they think certain variables are going to move. And based on that, and taking into account the client's risk parameters, taking both of these things together, they come up with the asset allocation strategy. So you come up with asset allocation strategy, and then once I know, okay, these are the types of, this is how much I want to invest in shares. I want to invest 25% of the money in shares. I want to invest 50% of the money in bonds. Okay? And the rest of the 25%, I want to keep 10% as liquidity for the client because of his unique needs. And the other 10%, I want to invest in short term, like maybe commercial paper or fixed deposits or something like that. I now have an asset allocation plan. From the asset allocation plan, I will move into what is my security selection. So these are two different strategies. What is my asset allocation? That's the most important strategy. Then I come to security selection. So I come to my security selection strategy. What do I mean by security selection? Security selection means what shares to invest in, what bonds to buy, what type of commercial paper to invest in. That's my security selection. So what shares to invest in? Okay, these are the shares that are going up these days. This is the rationale for me to invest in these shares. So I pick. So usually when we do, like when you try to pick shares to invest in, we do what we call, you can either do a top-down analysis or a bottom-up analysis. Top-down means you look from the point of the global economy, local economy, industry, share. You analyze downwards to try to figure out what shares to invest in. So globally, oil prices are going up, commodity prices are going up, US interest rates are behaving this way, US exchange rates are behaving this way. Right? How is that impacting country, local economy? Locally, with oil prices going up, my imports are impacted like this. Commodity prices going up, again imports are impacted. So how does that impact my exchange rate? In addition, US exchange rates are moving like this because US interest rates are moving like this. So how does that impact my exchange rates and interest rates? What are other factors that are happening locally? What is credit growth? What is the demand? What is inflation? And how is that impacting my interest rates? based on which direction I think exchange rates are going to go, interest rates are going to go, what industries will perform best. So if interest rates are going to go up, industries that are highly leveraged with a lot of loans are not going to do well. Industries or companies that don't have a lot of loans are going to do well. Exchange rates, Sri Lankan rupee depreciating is going to impact, let's say for example, export companies are going to get a benefit from this. Import-oriented companies, not so much. So like this, you figure out, okay, so then based on my analysis of what I think exchange rates are going to be and so on and so forth, these are the industries that I think will do best in this type of environment. Within these industries, so I pick either export-related industries or import-related industries. Depending on the industry, I pick, okay, export-related companies. What are the companies that are there that are in export-related manufacturing? Of these companies, what are the companies that are doing operationally well, operationally efficiently at this time? Because every single export company is not a company that I should be investing in. So what are the companies that have a story behind them that to make me believe that they will do well? Like this, I will choose, pick and choose different companies. This is my security selection process. So that's a top-down strategy. We start from the top and you work your way to the bottom to the company that you want to choose. You can also have bottom-up strategies where you start with the company that you want to choose and work your way to the top, where you say, okay, I think I'm going to buy this company because I think this company has potential to grow because of certain things that are taking place. Maybe there is a merger talk, maybe there is something going on. Okay, but then I see, okay, there is a possibility that this company is going to be merged with another company. Fine. So let me just see whether this is a good investment to make. This company is in this industry. Right now, this industry is performing like this. It's in the import-oriented industry, for example, or in the export-oriented industry. And export-oriented industries are performing like this. And we are expecting exchange rates to move like this. So therefore, export-oriented industries will perform like this. Let's say government will keep exchange rates steady. Exchange rates are not expected to move up. So I'm not expecting anything to happen here. So therefore, maybe company X, although it has some other good things about it, it has some negatives as well. So maybe company X is not the company to invest in. Like this, I pick and choose companies and figure out, go bottom up. Is there anything that is not conducive in its operating environment to make me not choose it? So top down or bottom up, whichever way. Different fund management companies will use different techniques to figure out what companies that they want to invest in. That's for shares. For bonds, you will look at what is your expectation on interest rates. Depending on your expectation of interest rates, you might decide if interest rates are expected to come down, I want to buy bonds. I want to buy bonds and I want to buy long-term bonds. So I want to buy, my security selection strategy will be, I want to buy the 2030 maturity bonds and the 2028 maturity bonds and the 2035 maturity bonds, right? So these are the types of bonds. These are the, let's say for example, most liquid bonds in the market that are trading, that are long-term. Because when interest rates come down, I want to buy long-term bonds to take maximum advantage of interest rate movements. But I don't want to buy illiquid long-term bonds. So I have to pick and choose the bonds that I want to buy. Commercial papers, FD, same type of analysis. Security selection would depend on, what is the company or bank I want to invest in. What are the banks or companies that I want to invest in? What are the riskiness of each of these banks or companies that I'm trying to invest in? Are they within my permitted investing limits? So each of these, we will select securities, sparring, taking into account the client's needs and special needs, right, to execution. And then finally, evaluation. Evaluation is that feedback loop is everywhere anyway. So every year or every 6 months, you have a sit down with the client, you have an internal discussion in terms of how the portfolios have performed. You sit down with the client, look at how the portfolios have performed, reevaluate strategies, reevaluate objectives, see if the client situations have changed, and reassess and see if any tweaks need to be done to your portfolio. So like this, it's a continuous loop where usually every year or 6 months, but usually every year, you will sit down with your clients and try to see, how best to tweak around your portfolio and whether your client situations have changed and whether anything needs to be reassessed in terms of the way the portfolio is managed. Any questions? Okay. So we come to retail clients. What are the options available for retail clients? So one of the options that are available for retail clients are unit trust funds or mutual funds. If they want to grow their wealth and get access to different markets, one of the options available to retail clients are unit trust funds. And this is not just retail clients, but mainly retail clients. If you look at private banking abroad, a lot of private banking arms abroad offer options to their clients in terms of unit trust investments. Not just retail clients, I'm talking about private banking, where you offer clients the ability to get into bonds, get into shares. Now the bank has its fixed deposit anyway, right? So you have private banks, for example, who's offering your client best services in terms of fixed deposit rates, in terms of loan rates. And then you also have these banks that are that want to offer a client another gamut of services, additional services. They don't want to just offer clients only their banking products, because that's not what the client wants. That's not true wealth management, right? So one way they do this, that I've seen, one way they do this is by offering different mutual funds to clients. So even if the client doesn't, you don't have a separate fund manager that will manage the portfolio for you, the unit trust fund enables you to give the client the benefit of bond investing or share market investing, which is managed by another professional fund manager, and the client has access to the market. And it's all through your bank. Right? So this is another way that foreign banks try to offer wealth management solutions even to their high net worth clients by offering them different types of mutual funds. So let's take a small break. It's 2:30 now. Do you all have a break in this class or not?
We usually have, madam.
Okay. So it's 2:30 now, and let's say 2:45. We'll start again. So we come to how retail clients can get the same types of benefits, although not the extensive types of benefits that are available for wealth management or in terms of high net worth clients, but certainly access to different markets that are generally only available to high net worth clients, which retail clients are not privy to. So this usually is done by this concept of what we call mutual funds, or in Sri Lanka we call them unit trust funds. Unit trust funds. What do we mean by mutual fund or unit trust? For the benefit of those of you who are unaware, essentially I'm just going to talk about what unit trusts are and how they benefit, or how you can benefit, or retail investors can benefit from unit trust funds. So essentially, unit trust funds are pooled investment plans. Excuse me. Unit trusts are pooled investment plans. Pooled investment plans mean you have many people getting together and putting their money into one fund. And you essentially get a professional fund manager to manage that money for you. Why do they do this? Because usually, if you ask a fund manager to manage money for you, they will ask for a high minimum investment. Usual minimum investment amounts can be even in the range of 100 million rupees. At a minimum, small fund managers may ask you about 25 million rupees. So if you want your money to get managed by somebody else who's supposed to be a professional, who's supposed to be in the market 24/7, you would need to have at least about a 25 million for certain fund managers, or about 100 million for larger fund managers, to get your money managed professionally. This is not a solution for everybody. All of us don't have the ability to, or don't have ready cash, or even cash, not ready cash, even assets lying around that are worth 25 million or 50 million or 100 million, right? So for the retail investor, it becomes a problem, because if you want to buy bonds in the market and you want to get bulk wholesale rates, you need to buy at least a 50 million size of bond. Each bond that you buy should be 50 million rupees worth. The face value of the bond should be 50 million rupees. Face value of the bill should be 50 million rupees. Usually companies will ask you, some companies will allow you to invest in commercial paper with as little as 1 million rupees, which is still not accessible to a lot of retail investors. Usually companies will ask you for about 10 million rupees to invest in commercial paper or securitized paper. So these are high minimums. As you can understand, it's not everybody who can have access to these markets. But why should you be excluded? Just because of a threshold of money. This is how the concept of unit trust started. Unit trusts allow retail investors to invest like big investors. Because what do? You pool together your money with many other small investors, and now you have one big fund. And this one big fund acts like one big investor. That's the concept of unit trust funds. You pool together the money to create a fund that acts like a big investor. So now the fund manager will be happy to manage a portfolio of 100 million or 200 million or billion rupee assets that are a pool of many people's money together. Why do fund managers usually ask for minimum thresholds of 25 million, 50 million, 100 million? Because, if you want to do a proper job, if you want to do a proper job in terms of diversifying the portfolio, allocating money to different asset classes and different securities, so that you are reducing risk, you need to have a good amount of money in your hands. Imagine, now finance theory generally says if you want to diversify your portfolio, you should hold ideally 20 to 30 stocks. Let's say 20 stocks. If I have 100,000 rupees to invest in the market, per share, per company, how much can I allocate with 20 stocks? 100,000 divided by 20, I'm allocating about 5,000 rupees per company. To buy 5,000 rupees worth of John Keys, 5,000 rupees worth of commercial pen, right? 5,000 rupees worth of Expo, or 5,000 rupees worth of LOLC. Or diversifying, but with small amounts of money. It doesn't make sense. So, this doesn't make sense, especially for a third party to do that with small amounts of money, because the time that's going to be consumed to create many types of portfolios customized to each individual like this becomes very time consuming. So which is why fund managers will usually ask you for minimum threshold. Documentation, time commitment, lack of the ability to diversify means that fund managers generally won't accept small amounts of money to manage on an individual basis. So you can't exclude the retail investor, which is why the concept of mutual funds come in. Here, what happens is your individual contributions are pooled together into a legally formed trust fund. In Sri Lanka, we pool together these contributions into a trust fund. That's why we call it a unit trust. And every investor has a claim on the proportion of the pool that they have invested. So, for example, if you have all these different investors coming together and creating a fund, that's now a ₹1 billion fund, right? Made from your 5,000 rupees and another person's 1 million rupees and another person's 100,000 rupees. Right. And like this, you allocate different people pooling the money and create a ₹1 billion fund. This fund, the fund manager can properly go and manage, properly diversify, properly look at the risk allocation. You don't have a lot of documentation trying to create IPSs for individual investors, for every single investor, right? So this fund, the fund manager is able to manage better. And you as an individual investor, you become a shareholder of this fund, meaning you have proportionate claim, not a shareholder, a unit holder, but you have proportionate claim in the returns of this fund. So let's say, for example, you invested ₹1 million. You are 1/1000th owner of this fund. You have 1/1000th because it's a ₹1 billion fund. You have 1/1000th claim in this fund. So if this fund goes from ₹1 billion to ₹1.1 billion, your 1/1000th claim would mean that your ₹1 million has grown to 1.1 million. So you have proportionate claim according to the proportion that you have invested. And the fund managers take this money and invest according to the investment mandate. So in a unit trust fund, what will happen? You have all these investors pooling together money to create a fund. This fund is generally created in the form of a trust, which is why we call it a unit trust in Sri Lanka. This money, because it's in the form of a trust, is governed by a trustee, meaning the money is safeguarded by a trustee. The fund manager goes and invests this money in the share market or the bond market or the corporate debt securities market according to the mandate that is given to him according to the fund's objective. But the trustee makes sure that the fund manager keeps to his mandate, manages this money according to the rules and regulations that govern the fund. What does that mean? So, for example, the trustee's job is not to tell the fund manager when the fund manager decides to buy, let's say, for example, he decides to go and buy different shares in the share market, because this is a share market fund. The trustee can't say, you know what, don't buy that share is not going to do well, that share is not a great investment. That's not the trustee's job. The trustee's job is to make sure to tell the fund manager, make sure you don't invest too much in that share. According to SEC regulations, because unit trusts are governed by SEC in Sri Lanka, the Securities Exchange Commission. According to SEC regulations, you're only supposed to invest a maximum of 15% per company. So make sure you don't breach those thresholds. This is a share market fund. You are not supposed to invest in, let's say, a bond through this fund. So this is not a permitted investment. I can't allow you to invest in that. But if it's permitted investment to invest in shares, the trustee can't pick and choose the shares the fund manager is going to invest. As long as the fund manager has a decision with him, a rationale and reason and logic for making his investments, then it's up to him to make, even if it's a bad choice, it's up to him to make then that investment. Okay. The trustee is there to ensure that he's protecting the safety of investors to the extent that of the rules and regulations of the fund. So right now in Sri Lanka, the trustee services that are done for unit trust funds are done by Bank of Ceylon, NSB, HNB, and Deutsche Bank. So these are the 4 banks that provide trustee services for unit trust funds in Sri Lanka. So always remember, the fund management company and the trustee must be independent of each other. You can't have the fund management company and the trustee be the same entity or group, subsidiary, associate type of situation. So, for example, if you take Bank of Ceylon has their C-Bank unit trust funds, right? The C-Bank unit trust funds, fund managers, C-Bank, investment banking, C-Bank unit, Bank of Ceylon, subsidiary of Bank of Ceylon. Trustee of the fund is NSB. Although Bank of Ceylon does trustee services, Bank of Ceylon cannot act as trustee to their own funds. It has to be an independent third party. So the fund manager and trustee will always be 2 entities. So the fund manager goes and takes, you will have different funds. People come and invest their money, pool together their money in different funds. So these funds, different funds will have different investment objectives. Some funds will be there to invest in the share market. Some funds will be there to invest in the bond market. And certain funds there to invest in corporate debt securities market. Okay. So depending on the investment objective, the fund manager will take the money and only invest according to the rules and regulations of the fund. So if it's a share market fund, he will take the money and invest in the share market. If it's a bond market fund, he will invest in treasury bills and bonds. Or if it's a corporate debt fund, he will invest in corporate debt. Okay. You can have combined funds, hybrid funds. Like, for example, you can have what we call balanced funds, which invest in everything. In shares, in bonds, in corporate debt, right? But that's the rules and regulations of those funds. The investors will choose which fund they want to invest in. Once they make that choice, fund manager goes and invests, and all the returns that the fund generates belong to the investors. How does the fund generate returns? So if it's share market fund, when you go and invest in shares, when the fund manager picks and chooses the shares that they want to invest in, some shares will go up, some shares will come down, depending on where the fund manager will invest. But all gains and losses belong to the investors. So the fund will receive capital gains if the fund manager buys shares and sells shares for a profit. If he sells shares for a loss, they will make capital losses. There can be unrealized gains and losses. Unrealized gains and losses meaning you buy shares, the share price has gone up, you haven't sold it yet. So you made a profit, but it's not realized. It's unrealized gains or unrealized losses. You can make money from dividends. When companies pay dividends, you will get that dividend to the fund. Just like that, if the fund is investing in treasury bills and bonds, treasury bills and bonds also have capital gains and capital losses depending on how interest rates move. Treasury bonds pay coupons, so the fund will get coupons. Excuse me. All these returns belong to the investor, right? So the investor can decide to cash in on these returns. Again, they can decide to realize this return, or they can decide just to let the returns be, but the returns belong to the investors. And this whole process is governed by the Securities Exchange Commission of Sri Lanka. Unit trusts are regulated by the SEC. They come under the purview of the SEC. Questions? No questions? Usually I have a fair amount of questions when we do this section. No questions? Remember, I can't see chat, so if you don't mind, please ask the question. Okay. So, this is the basic concept of a unit trust fund. Okay. We generally say unit trust funds promote disintermediation. Banks are intermediaries. Unit trust is a type of intermediary, but it promotes disintermediation. What does that mean? It means that in a bank, when you invest your money in a fixed deposit, right? For example, you give your money to a bank, the bank will take your money and maybe give out loans, right? So they will earn a return through the loan interest of the loans that they have given. So they make a certain return out of the loan interest that they have given, and there is a certain cost that they have to pay on their fixed deposits. Banks are intermediaries because no matter what profits that they make here, or losses in the sense whether this loan interest that they get is much higher or a little bit higher or not as high as the fixed deposit rates that they have promised. They have to pay, right? Unless the bank is in dire straits and not able to pay and going bankrupt, unless something bad is happening inside the bank, they will pay the fixed deposit rate that is promised. There is a promised rate and they will pay that promised rate. Unit trust funds, whether even if it is a fixed income fund, SEC says you cannot promise returns. You can show your current returns, but you can't guarantee returns because in a unit trust fund, you are disintermediated. All returns that the fund makes belong to you, belong to the investor. So it's not like the fund will make a certain return and then like a fixed deposit, you pay out something. Everything the fund makes will be paid out to the investor. This can be good and bad. Good when the share market has gone up 66% and the unit trust has also gone up quite high, 50% or whatever, all that 50% return belongs to the investors. Share market has come down 13%. Unit trust fund has also come down around that amount. Losses also belong to the investor. So pluses and minuses both, it's the investor, it belongs to the investor. Just like that, when you invest in treasury bills and bonds, treasury bills and bonds change with interest rates. When interest rates go up, bond prices come down. And when interest rates come down, bond prices go up. So unit trust will make capital gains when interest rates are coming down. Bond funds will make capital gains when interest rates are coming down. and we'll make lower returns. Usually you can make capital losses, but most of the time, because it's bonds, your returns will come down, right? So you can make capital losses as well, but your returns will come down. So pluses and minuses both will belong to the investor. Everything passes on back to the investor. They have the potential to make higher returns, but it's essentially you have the potential to make higher returns, and you have the potential to make losses as well. Yeah. So corporate debt funds, when you invest in corporate debt funds or money market funds, this is where you invest in lower risk funds, because these funds, especially money market funds, you're not going to see big fluctuations in returns, because money market funds don't change with interest rates. Money market funds only give you the rate of return that wherever this fund has invested in, right? So I'll talk about these different types of funds in a little bit, but whatever the returns that the fund earns belongs to the investors. So unit trust funds essentially pool together their investments of many different investors who share a common financial goal. People can invest in unit trust funds with a few hundred rupees. You don't have to be a millionaire to invest in unit trust funds. But you get access to the same markets millionaires get access to by investing through unit trust funds. So that's why I told you abroad, banks give you that option to invest in unit trust funds as well, of other. So they work together with unit trust fund management companies. Abroad, you call it mutual funds because of the way the fund is structured. You call it mutual funds. So you coordinate or you work together with other mutual fund management companies, and you offer their funds to retail or high net worth, usually to high net worth individuals, where you want to offer a gamut of investment opportunities to your clients. So if your clients want to invest in the bond market, you can offer them to go directly into the bond market through your treasury. Or if the client doesn't have enough money to put so much money into the bond market, but they still want to invest in the bond market, they can, even if it's a high net worth client, they might not want to put 50 million rupees into the bond market, right? So it depends on how much money they have and how much money they want to dispose per product. So then another alternative that these banks offer to them would be to invest in the same types of markets through a unit trust fund. Because you can invest in unit trust funds in Sri Lanka or abroad with a few, couple of thousand rupees or couple of hundreds of dollars, right? So it gives market returns. It doesn't give you assured returns. It will give you whatever the return that you're getting in the market, it gets passed on. Yeah, so the others I just talked about, like the securities are invested, and they are invested depending on the fund's objective, and also why were unit trust funds created as a mechanism for individual investors, especially retail investors, to obtain the benefits of large-scale investing. So you and I, even if not for your client, you and I, right? If we don't have, where we don't have access to different types of markets, you can get the same access through unit trust funds. So what are the benefits and concerns of investing in unit trust funds? Some of the benefits that you have of investing in unit trust funds, one is liquidity. Unit trust funds allow investors to come in to the fund anytime they want to and go out of the fund anytime they want to. You can invest anytime, withdraw anytime, and without your returns being impacted. So there are no penalties per se. So what will happen, for example, if you come into a share market fund and the share prices of the share market fund go up by 10% in 5 days' time, you can choose to, if you want to, you can choose to exit your investment. If you come into a money market fund, right, and the money market fund is giving you, let's say, for example, a 7% return or a 6% return, Whether you say 2 days or 2 weeks or 3 months, the return that you get will not be impacted by you wanting to withdraw your investment anytime. So unit trust funds provide you liquidity. It provides you direct access to capital markets with a small amount of capital. You don't need, for example, I told you bonds. For bonds, if you want the wholesale rate, not the retail rate, right? You know everything has a wholesale rate and retail rate. Yeah, you're all working in banks. You know that when you invest in large amounts, you get better rates than when you invest in smaller amounts, right? So at wholesale rates, you can invest in the market because with a billion rupee fund, even if I've only invested 5,000 rupees in that fund, with a billion rupee fund, the fund manager can go and negotiate for a 50 million rupee bond or a 100 million rupee bond and get a better rate. And that rate advantage passes on to me. And I get to invest in a bond with only 5,000 rupees at the wholesale rate. So it gives me direct access to capital markets with a small amount of capital. With a billion rupee fund or a 200 million rupee fund, the fund manager can diversify, right? So now you don't have to worry about, wanting to buy 20 different stocks to diversify your portfolio and having only 100,000 rupees to buy 20 different stocks. The fund manager will have 200 million or 300 million or a billion rupees in his portfolio, and he can diversify to his heart's content, right? So you come in, when you buy a fund, you're actually coming in and buying this diversified portfolio. And even if the fund manager doesn't want to diversify, the SEC makes sure that your portfolio is somewhat diversified at least. Because the SEC says in any fund, the maximum amount you can invest per investment, other than banks, the maximum amount you can invest per company is 15%. So at a minimum, you will be investing in about 7 different companies, right? So you guarantee that you're already going to be automatically diversified at a minimum. So you have that diversification advantage. Hopefully you have professional management, because that's why you're giving money. You should be searching out and checking out who are these fund managers, who are you investing with, what are their credentials. But these are people who are there 24/7 in the market. Your job, just like you are experts in banking, people in the fund management industry are 24/7 in capital markets. So their job is that, right? So hopefully you're coming into professional management. Cost advantages, just like I spoke about. Administration is convenient, meaning you don't have to, for example, now if you take money market fund, right? In a money market funds, we invest in multiple commercial papers, securitized papers, bank fixed deposits, different other types of it will invest in all these short-term investment products. If you want to invest in 10 different banks individually, you would have to fill out forms for every single bank. You would get a fixed deposit certificate, which you have to keep safe, make sure you don't lose it, of 10 different banks, right? But unit trust fund will do that investment one shot, keep that fixed deposit certificate safe. You don't have to worry about all of that. You just have one piece of paper of investment in unit trust fund. So you have return potential. On the concern side, obviously, you have the negative of that return potential because your returns are not guaranteed. And you have different choices schemes. You can decide where you want to invest. Do you want to invest in a bond fund, a share market fund, a money market fund, a corporate debt fund? You have flexibility, and it's regulated by the SEC. Of course, there are problems with unit trusts also. There are disadvantages of unit trusts also. So one thing, just like I said, returns are not guaranteed. Okay? So you get the pluses and the minuses of investing. Because it's an investment, and just like you invest in directly, even if you invest directly, if you're a high net worth investor, a high net worth client where the fund manager is managing your portfolio directly for you, not through unit trust funds, you still get pluses and minuses, right? Your portfolio can perform well or it can make losses. And the same phenomena is true for unit trust funds. But you can't customize your investments. You don't have a say. When you come and invest in a unit trust fund, you can't tell the fund manager, I'm looking for ethical investing, so please don't invest in tobacco companies and alcohol related companies. The fund manager will say, no, I'm sorry, you can't pick and choose the investments that we make. You will have to then try to find a fund that only does ethical investing. Well, there can be funds like that. So you can't customize investments. You can't tell the fund manager, buy this share, buy a lot of this share because this share is going to go up. This is the share I want to buy. If the fund manager is making decisions on behalf of tens of thousands of people, you're just one person out of the tens of thousands of people inside that fund. So you have to depend on what the fund manager will do for you. And one of the other concerns are some funds will have high management fees and sales commissions. So you should always check in your unit trust fund wherever you want to invest or you recommend your client to invest. Are these funds with lower sales commissions, lower management fees, because you don't want to give your clients funds with higher management fees. Questions?
Yes, madam. Convenient administration mean what kind of that administration for that fund? So
No, administration for you. Convenient administration meaning as an individual. So like I was saying, if you wanted to go and make different investments, let's say for example, you go today, you look around for rates and you say, okay, this bank is giving me the best rate, so I'm investing with bank X. Right? 1 month later, some other bank is offering you a better rate, so you go and invest with bank Y. Like this, at different points in time, different banks will offer you better rates, not just banks. Different commercial papers, different debentures, different, so all these different places where you want to invest. So suddenly, you find that you invested in 10 different places, you have, and at different points in time, the same place twice. Now you have all these 50 different certificates with you that you have to make sure you keep. You have to make sure that you go and take your money out at the right time. If you don't have your certificate, that becomes a problem. You don't have any of this when you come, like if you come into a mutual fund, because you're asking somebody else to do all those choices for you. So the only thing you will have is a type of receipt, just like when you put your money into a fixed deposit, you get a DMAT certificate, right? So just like that, you will have either in a physical form a confirmation that says you have invested in the unit trust fund, or in digital form a confirmation that says you have invested in a unit trust fund, and it's just that one document. That's what you mean by convenient administration. Any other questions?
in that mean all the documents part keep it with us, no, in our custodies.
The unit trust fund will keep it separately. For an individual investor, he doesn't have to worry about where the unit trust is investing. He just has one piece of document with him that says he has invested in a unit trust fund.
Right, okay.
Other questions? So, mutual funds can be classified in different ways. Let's talk about 3 broad classifications. 3 ways mutual funds exist. So, you can classify mutual funds according to its structure, based on their investment objectives or based on their investment style. What does this mean? What do you mean by based on? So based on investment objective is the one that will be most relevant. But just to give a quick understanding of what do you mean by based on structure, mutual funds can be classified as open-end mutual funds and closed-end mutual funds. Right now, today in Sri Lanka, all our mutual funds are open-end mutual funds. We don't have exchange rate funds. Exchange rate funds have never been introduced to Sri Lanka as of today. Right? We don't have closed-end funds. Closed-end funds have been in Sri Lanka, but right now all closed-end funds have expired. Right? Their lifetime has finished. So what is the difference between an open-end fund and a closed-end fund? In an open-end fund, so these are two different types of funds. Just like I said before, you have people coming in, pooling your money into a fund. Right? But open-end funds are funds that have no maturity date. They are there forever. Until something happens, the fund management company decides to wind up and pay the money back. Until something happens, the fund will exist forever. Right? So there is no fixed maturity date. In these funds, people can come in any time that they want to, go out any time that they want to. These funds will accept continuous sale and purchase requests. Continuous sale and purchase requests meaning you can invest money anytime you want to, withdraw money anytime you want to. And so the fund size varies. Always the fund size will vary. So for example, when people come and invest money, more and more money into the unit trust fund industry, the fund sizes go up because more and more money comes into the fund. And as people take out the money and go and invest in other alternatives, because right now the other alternatives are better, the fund size comes down. So in open-end funds, the fund size keeps on changing. And with the fund size keeping on changing, the capital inside the fund and the number of units inside the fund keep on changing. What that means is, now let's say for example, I have a 100 million fund, and I'll talk about NAV in a minute, so just think of this as the price of the fund. Okay? The price that you buy units in the fund at. So let's assume you have a fund that's $1 billion big. Right, so a $1 billion fund. And right now the price or NAV of the fund is 10 rupees. This should imply to you that the fund has 100 million units. I hope you understand that. The fund has 100 million units. 100 million units into 10 rupees each makes a $1 billion fund. Okay. So you have people that are coming in. Anytime a person comes into this fund today, now this fund's price is today 10 rupees. Right. Let's say a person comes in and he wants to invest 100 million rupees. I take a big number because I want to show you how the fund changes. When a person comes in and invests 100 million rupees, he gets allocated units inside the fund and the fund grows. So he will come and buy units at 10 rupees each. So what will happen to the fund immediately as he invests? Same day, same time, as soon as he invests, the fund will now grow by 100 million rupees to 1.1 billion. Price is still 10 rupees. It's the same day, same time. So 1.1 billion divided by 10 rupees, the fund now has 110 million units. How did the fund get the 110 million units? The fund issued 10 million units to this guy, to the guy who bought in 100 million rupees. He created and issued 10 million units to him. So every time a person comes into the fund creates new units and issues it to the investor. So the investor gets a piece of paper, digital or physical, that essentially says, you have invested 100 million rupees and 10 million units have been allocated to you. And it's not about your investment. What's important is this 10 million units has been allocated to you. Right? So now, assume a few days or weeks or months pass. Different people have come to the fund, gone out of the fund, right? Whatever. And now the unit price is, let's say, 11 rupees. Okay. Let's assume the fund is now a 2.2 billion fund. To make my calculations easy, so that implies the fund has 220 million units. Do you see how it has this fund grown? Because new and new people have come and invested in the fund. Every time people invest in the fund, new units have been created for these people at different prices. If a person comes in today, he will be created new units at 11 rupees. So at these different prices, they get created units, and now after some months, the fund is now 2.2 billion. Your unit price has grown from 10 rupees to 11 rupees. Now this person decides, okay, I want to take my money out. What will he say? He will go to the fund manager, he will give back his certificate, or if it's in digital form, he will let the fund manager know, I want to withdraw or redeem. I want to withdraw or redeem my 10 million units. See, it's not about my 100 million rupees, it's about my 10 million units. So then what will the fund manager do immediately? He will take that 10 million units and redeem it, cancel the units. So now the fund becomes a 210 million unit fund, right? Because the fund had 220 million rupees at the start of the day. This investor came and said, I want to withdraw 10 million units. So now the fund becomes a 210 million rupee fund because this 10 million units get cancelled off. The fund price doesn't change. It still remains at 11 rupees. So that means this fund is now how big? 210 million into 11 rupees. Oh, sorry. This is 200. No? 2.2 divided by 11 is 200
unit.
Yeah, sorry about that. So then this becomes 190 because 10 million units get cancelled out. We're left with 190 million units inside the fund. So 190 million units into 11 rupees. Now the fund value is 2090. Yeah. Oh, where is the difference? Where did that go to? It went to the client. Right. So now the client earned on his investment 110 million. Right. How do we know that? Because he had 10 million units. Now these 10 million units are worth 11 rupees. So when he comes to the fund manager and says, I want to withdraw my 10 million units, what happens? At 11 rupees, the fund manager pays him back 110 million rupees. And inside the fund, what happens? Because the cash goes out of the fund's value comes down from 2.2 billion to 2090. And the fund's number of units also come down by 10 million because that's the amount of units that this client redeemed. And therefore, there's no change to the price of the fund. So that's why I said what's important is not how much the client invested, but at the time of investment, how many units he was allocated. As soon as he knows the number of units that gets allocated to him, that number of units, he can look at the price and see how his value of his units are growing or value of his units are coming down, how they are fluctuating. So That's why we say unit capital and the number of units are not fixed. It can go up, it can come down. Because you have transactions happen with the fund manager, you get units that are created and units that are redeemed at the price of the fund, which we call the net asset value. NAV means net asset value. I'll come to what that means in a minute. NAV means net asset value of the fund. So this is what happens in an open-end fund, and this is the type of fund we have in Sri Lanka right now. We don't have any closed-end funds in Sri Lanka at the moment. We had, right? The two most famous closed-end funds that we had were listed on the Colombo Stock Exchange, called the Nama Equity Value Fund and the Canada Opportunities Fund. But both of them have now expired, finished, right? So they have matured. That's the word I was looking for, matured. So, okay. Any questions on open-end funds?
So that means the client wants that units. That means he want to sell to somebody, no?
No. He sells it back to the fund manager.
A fund manager. Fund manager wants to do that. So
The
that
fund
means
manager will always do that.
He need to sell that units and then he will return their money, no?
That's right. Yes. So you see, the fund is quite big, right? The fund is a billion rupee fund, and this is typically in a unit trust environment. You will have 200 million rupees, billion rupees, 30 billion rupee type of funds. So always the fund manager will keep a certain portion as liquidity. So they are able to anytime cater to their clients and give the money back. So this is mandated by the SEC as well. SEC mandates at least minimum you keep 3% of the money in the fund as liquidity. Liquidity means cash or near cash, so that you are able to facilitate redemptions on any day to your clients. So some funds have higher liquidity than what is mandated by SEC. So some funds, for example, have 10% liquidity that they keep. Especially money market funds sometimes have 10% liquidity that they keep to facilitate clients coming in and going out anytime. So imagine on a 30 billion fund, that's 3 billion worth of liquidity, cash or near cash, that the fund keeps to make sure that they're able to facilitate any withdrawals or redemptions in the fund. So always the client doesn't have to search for investors. Client just goes to the fund manager. Fund manager will always take the certificate, give the money back. The fund, how does he give the money back? From the liquidity inside the fund. So the fund value will come down and the number of units will change, but the fund price will not change.
It's the responsibility of the fund manager. If they any now it's earlier 10 rupees, then after 11 rupees, no. If fund manager wants to educate the customer, is it now to sell
or whether to sell or not? No.
Yeah.
See, you're looking at a lot of retail clients, right? So it depends on how much the fund manager is geared to be able to educate the retail clients in terms of, okay, now it's a good time to sell or now it's a good time to buy. Certain fund management companies will have sales force who will be responsible for each of these clients. Some fund management companies will not. Depends on the size of the fund management company. But also it depends on what type of fund this is. If it's a share market fund, then you can say, okay, now time to move out of the fund to a different fund. Now time to come into the share market. Now time to go out of the share market. But if it's a fixed income fund, generally it's fixed income, right? It's much more stable. So then the people are investing in the fund for the stable returns. So there is not much education of that type required.
Scenario same like a share market, but the problem that a fixed income is there, no?
Why do you say it's like a share market?
Share market also same like that. The one unit, no, that one share price. Then if his share price is up, then he can ask from their brokers. Then they can ask them to sell that shares. No?
Yes, but here
Same thing happen here. No?
Similar thing happens here, but here you don't see if it's in fixed income. you can decide whether because it's fixed income means you're just getting steady returns, right? So this fund is giving you from 10 to 11 rupees, it's giving you a 10% return
Okay.
over a
Yes.
period of time. So let's say this is over a year, you got a 10% return. And then it's not like your returns are going to come down in a fixed income fund. Sorry, your prices are going to come down in a fixed income fund. Your prices will keep on moving, but if interest rates come down, the rate that the prices move will come down. Right? So instead of moving up by 10%, it will move up by 5%. It's not going to make losses. Right? So the unit trust fund anyway, the interest rates will change around with the interest rates in the market, because the unit trust fund goes and invests in fixed income instruments that are there in the market. So I'm going to erase this now. Come to closed-end funds. So in closed-end funds, look at the difference. Open-end funds had no fixed maturity date. Closed-end funds have a fixed maturity date. Open-end funds, anytime the fund manager will accept continuous sale and purchase requests, meaning the fund manager will accept investments from you and the fund manager will redeem investments for you. So you can take your money out anytime you want to. In a closed-end fund, closed-end funds are usually funds where you open up the fund for a limited period of time, right? Like say 1 day or 2 weeks or something like that. You open it for a limited period of time and then you close the fund until it matures. Once you close the fund, you can't take your money out from the fund manager until the fund matures. So you have to wait. So usually these funds, like for example, the very first fund that was listed on the Colombo Stock Exchange is the Normal Equity Value Fund. This was a 10-year fund. So the fixed maturity period was 10 years. The Canada Opportunities Fund came next. This is a 5-year fund. Right? So these funds, once you come through the IPO and you invest money in the fund, you have to wait without taking the money out until this fund matures. So obviously you can understand people are not going to want to wait until the fund matures to take their money out, which is why closed-end funds usually get listed in a stock exchange. So in Sri Lanka, these two funds got listed on the Colombo Stock Exchange. You can see when they came in, you had to wait for 10 years or you could trade in the market. So the market price will go up and down, and depending on where market prices are, you can decide to buy or sell shares of this fund. So here you don't deal directly with the fund manager, you trade in the secondary market. Any questions?
So what is the meaning of NAFV and
Normal Equity Value Fund. So this is
now?
the name of the fund, Normal Equity Value Fund. This is the Normal Fund Management Company as well as Equity, which is the joint venture between DFCC, HNB. They got together and did this fund called Normal Equity Value Fund. This is the first closed-end fund that was listed on the Colombo Stock Exchange. And this is Canada Opportunities Fund. Canada Opportunities Fund. So let me just show you some details here. So this is the unit trust. Yeah, go ahead.
Normal mean company?
Normal is a company, yes. So this is the unit trust association, right? So if you look at, these are all the different fund management. We currently have 14 different fund management companies in Sri Lanka. This is Normal, National Asset Management. Right. And if you see, hope it loads up. Always you have to stop it. Okay. So you can see here the price of each of these funds. So you can see these are the different unit trust funds offered by different companies in Sri Lanka, right? So you have, for example, Asset Trust, Asset Line, Senfin, Cal, C Bank, Comtrust, First Capital, Guardian, JB, NDB Wealth. Namal is also here. They haven't posted their prices on this day, right? So the different prices that the fund manager will buy or sell units at. Because remember, we only have open-ended funds in Sri Lanka right now. And these are all different open-ended funds that are available in Sri Lanka at the moment. Just see if network on.
Why is that some companies having the same prices in buying and selling?
Okay, good question.
Why why some companies having buying and selling price same prices?
Yes. So some companies you can see will have the same price for buying and selling, and some companies will have a different price, or the same company for different funds will have a different price for buying and selling. Usually, this phenomena is seen usually for fixed income funds, the buying and selling price is the same. But for equity funds, right, share market funds, generally there is either an entry fee or an exit fee that gets charged when you buy or sell. An entry fee when you buy units or an exit fee when you sell units. This is if it's buying, if it's an entry fee, it's to pay off commissions. Right? If it's an exit fee, it's because it's to deter investors from moving out of the fund for a period of time. So if it's like an exit fee, it's an exit fee is not forever. An exit fee becomes zero, and the buying and selling prices will become equal after a period of time. So usually exit fees are for like a year, right? Where the fund manager says in equity funds, because equity is long-term investments and you want to entice investors to stay long-term. So the fund management companies say, if you stay for 1 year, there will be no exit fees. But if you want to take your units out, redeem it within 1 year, there will be an additional fee charge just because I will then have to, change my strategies around. So to entice people to stay for a longer period of time, sometimes funds charge exit fees, which is why you will see a difference in prices. But most of the time, if you see income fund, that's a fixed income fund, no difference in price, right? Alpha fund is a equity fund. There is a change in price. This is not coming up. Sometimes that happens. So these are all money market. Sorry, these are all different unit trust funds. Let me just also show you. Give me 1 minute. Are you seeing my screen now or not seeing my screen?
No, we can't see that.
I can't see the screen. Okay. So you can see the share market screen, right?
Yeah.
Okay. So let me show you normal equity value fund. Remember, this is a share. It's a unit trust fund that was trading in the share market. It had a period of 10 years. It was open for a period of 10 years and then the fund matured. So right now this fund has matured. It's not trading in the share market anymore. So you can see, if I show that, normal equity value fund, right? That's an AVF. So normal equity value fund actually came to the market, I believe, just post what, 2009, September. And it was open to investors. It did an IPO. Remember last time I did the lesson, I talked about IPOs, initial public offerings. It asked investors to invest in the fund. It did an IPO in 2009 September, and the fund was then closed and managed by the fund managers for 10 years. And at the end of 10 years, 2019 September, the fund was distributed. Whatever cash inside the fund was liquidated, and whatever cash inside the fund was distributed back to investors. So here you can see, you can't see 2009, that data is not available, but this is the share price movements of normal equity value fund. Why are there share price movements of normal equity value fund? Because the fund manager is managing the fund. Investors can't go to the fund manager and get the money out. The investors have to trade among each other, sell your shares to somebody else if you want to exit the fund before it matures. So you can see here that investors actually have traded in the fund, sold their shares to different people when they wanted to exit. Okay. So closed-end funds are usually listed on a stock exchange. So that was based on structure. You have open-end and closed-end funds. I'm not going to talk about exchange-traded funds because we don't have them in Sri Lanka at the moment, right? So it's not even available in Sri Lanka. Then you can classify your mutual funds according to your investment objective. What type of fund do you want to invest in? Do you want to invest in a debt fund, an equity fund, or a hybrid of the two? Right. If you're investing in a debt fund, you have different types of debt funds. You can have money market funds, gilt edge funds, or income funds. Money market funds mean funds that are investing in short-term corporate debt as well as government securities, but short-term. Why the term money market? Money market means instruments that are that have a maturity of less than 1 year. So money market funds invest in, take your money, pool together the money, and the fund manager will go and invest in short-term government securities and corporate debt instruments. Short-term means less than 1 year. So some examples of investments inside money market funds: treasury bills, repo agreements, repurchase agreements, commercial paper, bank FDs, securitized paper, less than 365 days. Okay. So these are some examples of investments inside money market funds. So when you invest in a money market fund can be invested in repo agreements, treasury bills, bank FDs, commercial paper, securitized paper, things like this. You can decide you want to invest in a gilt-edged fund. Gilt-edged means government securities, like gold. That's what you mean by gilt-edged, like gold, right? So these are funds that invest in government securities. So government securities funds, if you choose to invest in a government securities fund, gilt-edged funds will invest in treasury bonds, treasury bills, and repo agreements that are backed by government securities. So they only invest in government securities, but it can be long-term or short-term because treasury bonds are also there. So it can be in long-term government securities or short-term government securities. Income funds?
Excuse me, repurchase agreement means repo?
That's right. Repurchase agreement means repo. Income funds invest in any type of fixed income instrument, short-term and long-term, government securities and corporate debt. So you can see the number of types of investments it can make is vast. Treasury bills, treasury bonds, repos, commercial paper, FDs, securitized paper, debentures, right? It has no limit in the type of investments it can make. So as an investor, if you decide to invest in a debt fund, you can choose what is, remember I told you, as an investor, you should be thinking about what is your investment objective, what are you saving for, and what type of return do you want. Okay. Even as a retail investor, even for you as a personal investment, if you're thinking about investments, and here remember, you have to, when you're thinking about investing for your retirement, you have to think about beating inflation and investing in long term. One of the biggest problems in Sri Lanka is that Sri Lankan people don't think about investing long term. Look at most of your bank fixed deposits. Where is that concentrated in? Right, a lot of clients are investing short term, aren't they? The maximum tenor of most of your bank fixed deposits taken up by clients will be less than 1 year. You will have very few clients going for more than 1 year. Same way, if you think about unit trust funds, the most popular type of unit trust fund that is there right now is money market funds, because still people think about investing short term. But if you really, really want to think about investing for retirement, for life goals, for intergenerational wealth, right? It doesn't have to be for high net worth individuals. This is for you. You need to find products that will beat inflation. You need to invest long term. And although there are products that will beat inflation, sometimes it's not accessible to us. Unit trust funds give us the opportunity to access them. But you have to be able to invest in these long-term products and hold your money for long term, right? So what are products that beat inflation? Long-term income products, right? Long-term fixed income products will beat inflation. Share market products, share market investments will beat inflation. Treasury bonds should beat inflation, will beat inflation. Right? So you have to invest in these types of products. In any of these funds, whether it's money market, gilt-edged or income, you can come in anytime and go out anytime. Invest, withdraw anytime you want to. You are not restricted. But still, people are comfortable investing in this segment. They're not comfortable trying to invest in longer term products, right? So these are problems with Sri Lankan. As Sri Lankans, all of us have that same mentality, and we can't. If we want to save, if we want our wealth to grow, you have to think about investing long term. You have to think about debentures. You have to think about, treasury bonds, long term products. Right? So if you want to manage it yourself, you should be thinking about investing directly in treasury bonds, debentures, securitized paper, in long term products, shares, right? If you don't want the hassle of managing it yourself and you don't have the money, or you don't have the money to manage it yourself, you come into a mutual fund and invest in long-term products, because that's the only way you are going to be able to build wealth, right? So you can do it yourself, or you access it through a mutual fund at the capital markets, but it's not enough to think about investing in short-term products and try to beat inflation and increase your wealth. And that's a very important thing that we keep on forgetting. So these are different types of debt funds that are offered. Even in share market funds, you have different types of share market funds, right? So you have growth funds, which are funds that are invested in shares, equity. You can have index funds. Index funds are invested in specific sectors, right? So you have, sorry. I don't know why I said that. Index funds are invested in the share, an index, right? It tries to mimic an index. So, for example, now we don't have many index funds in Sri Lanka. We used to have something called the Arpico Atraxia, which was the fund management company. Arpico Atraxia S&P SL20 index fund, which tried to mimic the S&P SL20 index. So if you look at the Arpico Atraxia S&P SL index fund, S&P SL20 index fund, it tried to invest in the 20 shares that were in the index. Now, if you look at how the index has performed year to date today, the S&P SL index has gone up 46%, right? Increased by 46%. So if you had invested directly in these 20 shares in the same proportion as the index, your 100,000 rupee investment would have also gone up to 146,000 rupees. Another way that you could have invested is if there was an index fund available that was mimicking this index, you put your 100,000 rupees there. You don't have the administrative hassle of buying 20 different shares, and you still get that 46% return. Right? So index funds invest in or try to mimic. The fund manager tries to create a portfolio that mimics an index. We don't have proper index funds. We have an index fund which has a customized index, right? So you have to observe that index and see whether that's an index that you want to invest in. But we don't have index funds of observable indices like the SPI or the S&P SL20. We don't have those right now in Sri Lanka. Then sector funds are another type of share market fund, but only invest in certain sectors. So in Sri Lanka, we have the banking sector fund, which only invests in banking sector shares. So if you think the banking sector is going to do really well, and you want to buy, one shot the banking sector, you can buy a banking sector fund. You have the tourism sector fund, just like the name implies. If you think, okay, tourism sector has come down a lot now, share prices are depressed. Now is the time to buy tourism sector because it's going to perform well. I am not giving you an investment recommendation, by the way. I'm just telling you a scenario. If you think that is the case, you can buy individual tourism sector shares, but then you will have to do analysis, figure out what are the shares that you should buy, how much, how to diversify, right? Or you can straight away come and buy shares of a tourism sector fund, which will anyway be invested in this portfolio of tourism sector shares. And finally, you have balance funds. Balance funds are a hybrid fund. Remember I told you, it's the combination of debt and equity together. So balance funds will have everything. It invests both in debt and equity. So it will have all of these things plus shares. So balance funds can invest in anything. So they might have 50-50 debt to equity, 60-40 debt to equity, depending on whether the fund manager feels the debt market will do better or the equity market will do better. Asset allocations will change mildly, but you will invest in all these different types of instruments. So if you look at, just to get an understanding of where the risk and return lies of these different types of funds. Okay. See in the debt fund graph, do you see money market funds have the lowest risk? Gilt-edged money market funds have the absolute lowest risk. So this is returns versus risk. Obviously, higher the return, higher the risk, right? Or higher the risk, higher the potential for higher return. So gilt-edged means government securities. So money market government securities, that's essentially funds invested only in treasury bills and repos, maybe treasury bonds less than 1 year, right? But very short-term products. Gilt-edge money market funds have very low risk because they are in government securities, they are default risk-free, right? And then they are short-term, so they have very low risk. But the return potential is also lower because of the lower risk. Similarly, if you talk about money market funds, which can invest in bills, repos, plus other like FD, securitized paper, commercial paper, less than 1 year. These are low risk funds. Do you see gilt-edge funds, which are government securities funds, I have classified a little higher than money market funds. Government securities are default risk free. So why have I classified it higher in the risk scale?
Depend on the economy.
So depending on the economy means government securities change according to interest rates. When interest rates go up, government security prices come down. And when interest rates come down, government security prices move up. So government securities can give you capital gains and losses, especially when you're trading in bonds. Okay. So money market funds don't have that same problem because these types of funds, the SEC doesn't require you to change according to interest rate changes. But gilt-edge funds and income funds, the SEC requires you to show the value according to interest rate changes. So when interest rates change, the fund prices change. And when interest rates go up, gilt-edge funds actually can make lower returns. Prices can come down. Okay. So because of this, gilt-edge funds have higher risk. Although they are default risk-free, they have they have higher risk, meaning they have potential for higher return, but they also have potential to make lower returns or losses, right? So income funds have both. They have that default risk plus interest rate risk. But remember, risk is just potential. It's the variability. It's the fact that you may or may not achieve your return. So income funds, gilt-edge funds give you the potential for higher return, right? They also give you the possibility of risk. But this is why I said, that's why a lot of people don't still invest in income funds and gilt-edge funds. But if you want to save towards retirement, if you want your wealth to grow, you have to go towards long-term products. And these long-term products, although you can come in anytime you want and go out anytime you want, in one day even, you can move out of these funds. But to get the best returns, you should be staying long-term. And these are the funds that have the potential to give you long-term, better returns. Okay. Equity, same way. You can see here, if you take growth funds, right? Growth funds are share market funds. Do you see sector funds have higher risk than growth funds? Sector funds have higher risk than growth funds because they are concentrated to a specific sector. Diversification is lower. Imagine these days, you know, tourism sector is not doing well. Imagine whole of last year, tourism sector fund would be making losses, right? Because it's concentrated to the tourism sector. It's not diversified fully. So sector funds have higher risk, but they also have higher return potential. Meaning, when the sector starts to turn around, these funds will do much, much better than just investing in a diversified portfolio of shares. Right. Balanced funds have both equity and debt in some portion, which is why it has debt also, which is why it has lower risk than growth funds. And index funds classified lowest because it tries to mimic an index which is fully diversified. So depending on how much debt it has, these two can change around right? The balance fund can be lower than index fund or vice versa. That can change around. Any questions? And the final classification, right? So we talked about structure, investment style, and investment type, objective and style. So what do you mean by investment style? How the fund manager manages the fund. Does he manage it passively or actively? Essentially, passive funds mean things like index funds, where the fund manager doesn't have to do a lot of work. He just says, I'm going to invest in an index. I'm going to mimic or replicate a market index. So here, the fund manager's job is to like, so you say, I told you that other fund that we used to have in Sri Lanka, Apico Atraxia, S&P SL20 fund. Here, these fund managers would have looked at, okay, we have to mimic the S&P SL20. So let's see what are the shares inside the S&P SL20. S&P SL20 generally has 20 shares, right? With the non-voting shares, it might be slightly more than 20. And then let's say it has John Keys and it has 15% of John Keys. So my fund, which is a let's say 500 million rupee fund, 15% of that fund I will allocate to buy John Keys. Then let's say it has HNB, and let's say it has 8% of HNB. So 8% of this 500 million, the fund manager will allocate to buy HNB. They don't need to do any analysis because they are following an index. They don't need to see whether John Keys is a good share to buy or not. It doesn't matter because they have to follow the index. As long as the index has it, they have to buy it. They have to mimic the index. Right? So index funds require lower effort by fund managers, comparatively lower effort by fund managers. Therefore, though, the fees charged by index funds are generally lower. All other funds are active funds, where fund managers will actively look at companies, try to pick stocks to invest in, right? So therefore, they will try to beat the market. Sometimes they will do better than the market. Sometimes they will do worse than the market. But the objective is to try to beat the market. But because they are doing a lot of work, they will also charge a lot of fees. So active funds can carry higher fees than passive funds. Any questions? Okay. So this is what I was talking about. The price of the fund. We call that the NAV of the fund. The NAV of the fund, or the published price of the fund, essentially is the total, looks at every single day. It values all the securities inside the fund, right? It values every single security inside the fund, and then it looks at how much outstanding units do I have in this fund, and deducts it, divides it to come up with the net asset value per unit of the fund. Say, for example, on a certain day, this fund has, let's say, John Keys, it has Expo, right? It has LOLC, right? And today, according to the proportion of shares of Expo, John Keys, and LOLC that I have, right? And the price of John Keys, Expo, and LOLC, right? All the stocks inside my fund is worth 350 million today, as at the 3rd of December, Friday. Then I look at all the bonds inside my fund, bonds and other fixed income instruments. Based on the interest rates today, the price of all the bonds that I have invested inside my fund is worth 150 million rupees. Then cash inside the fund is worth 24 million rupees. In total, my funds, all the assets inside my fund, stocks, bonds, fixed income, bank fixed deposits, everything together today has a total asset value of 524 million. Up to today, the fund has incurred expenses of 8 million, which means the net asset value. So you see, total asset value minus fees gives me the net asset value of the fund. The net asset value is 516 million. Per share, net asset value is 516 divided by 15 million. The price of the fund of 34.40 comes by looking at all the value of all the investments inside my fund minus expenses divided by the number of shares. Right? And every day, this value gets marked to market. Means every day the share prices change. So every day, this value of stocks change. The value of bonds change. And therefore my NAV changes. Questions? So those prices that you saw in that PDF that I showed you, that's the NAV of the fund. Each day, the price would change based on the NAV of the fund. So if we look at those prices, I hope you can see this again. I've opened up the unit trust price sheet. Do you see on the 30th of November, I take a fund that's, so the asset line income fund. You can see from the name what type of fund this is, right? This is a fixed income fund. This is a income plus growth, meaning this is a balanced fund. This is an income fund. You see, this is a balanced fund. This is a money market fund, right? So from the name, you can see what type of fund it is. Let's take this fund. Look at this fund's NAV. The money market fund NAV is 15.85, and it doesn't change because there are no other additional commissions that you have to pay, entry fees or exit fees, right? And always in fixed income funds, there are no entry fees or exit fees in unit trust funds. Do you see on the 30th, Senfin Money Market Fund has a unit selling price, buying price, or NAV of 15.8596. On the 1st of December, 15.8596, right? On the 1st of December, yeah, 15.8627. Yesterday meaning the day before, it was 15.8596. Today, on the 1st of December, it's 15.8627. Why has that NAV gone up? Because all the assets inside the fund has accrued interest by one more day. So now the updated value of all the assets inside the fund minus the fees, the price has moved up.
How do you know how many units are there?
So when you go and invest in a fund, the fund manager will give you a digital certificate or give you a confirmation that says this many units have been allocated to you. So as soon as you make your investment, by the end of the day, you will know how many units have been allocated to you. Okay, so some of the expenses that are charged in unit trust funds. Oh, sorry, let me show you this first. So this is the NAV of a mutual fund. Do you see in a growth fund? Growth fund means share market funds, right? Look at these examples of, this is a growth fund. What is a growth fund? This one is a growth fund, right? This is the unit trust fund, and this is the share market, the ASPI, the All Share Price Index movement. Do you see this growth fund, this unit trust fund, share prices go up, sorry, unit prices go up, unit prices come down, has pretty much followed the movements of the share market itself. So when you wanted to get exposure to the share market without going and buying shares on your own, you can do that. That's one option. You can also buy shares through a fund, and you will get the same type of returns, right? Every fund won't give you the same type of returns, and every fund every single time won't give you the same type of returns. It depends on the fund's objective, so you should talk to the fund manager and see what they are doing. Do you see here? This shows you from 2016 to 2021 how a money market fund's price movement has been. And do you see money market fund prices always keep going up? But the only thing is, if you can see, it's very subtle. I hope you can see. See, in 2016-17, interest rates were high. So the speed of going up versus in 2021-20, the speed of going up, the slope. You see, this slope is lower, this slope is higher. Because when interest rates are high, you accumulate interest at a higher rate. So you're not making losses when interest rates come down. But you're now, when interest rates were 5%, this fund is also still going up, but now at a lower rate of 5% or 6%. Right? So money market fund prices, you see, are always moving up, but the slope keeps on changing depending on the interest rate environment. Bond funds, you see, sometimes can give you sudden jumps in returns. When interest rates come down, bond funds are pretty much going up, pretty much. Over a long period of time, you're still making positive returns. For very short periods of time, you can make negative returns. Do you see here? Here, this is a period, July to August. We all know July to August, there was sudden increase in interest rates. What happened to the bond fund price? Bond fund price has fallen, right? And August to September also there were still increases in interest rates, but it looks like the fund manager sold off the bonds, cut their losses, right? And waited because the bond fund price hasn't fallen from that point. But bond funds can give negative returns over short periods of time. When you hold it for long periods still, you see, overall the fund is giving you better returns than even a money market fund. Which is why I say, always look at long-term investments. Whether directly or through unit trust, it doesn't matter. Just as an advice to you, I'm saying, always look for long-term investments if you want to grow your wealth. So these are the different types of fees that are charged in unit trust funds. Right? These are not, although it seems like a lot of fees, all of these fees are not relevant for every single type of fund. So remember here, when you come up with the net asset value, you deduct your expenses. You take all the asset, the value of all the assets inside the fund, and deduct your expenses. Right. The permissible expenses that you're allowed to deduct are these. Every single expense is not relevant for every single fund. But in general, the first 3 or 4 expenses are there for all funds. Fund managers will charge a fee. There's a trustee for the fund, remember? There's a trustee. And usually a custodian as well to keep, for safekeeping of your, deposit certificates, your share market investments and so on. So there will be trustee custodian fees. There will be audit charges and legal or tax fees. These top 4 will be there for pretty much all funds. Other expenses may or may not be there. Most funds will not have these other expenses, right? So when you come up with the NAV is always after deducting net asset value. It's always after deducting expenses. So expenses include fees paid to fund managers, which is for fixed income funds. Usually fees paid to fund management fees are in the range of 0.5% of the fund size to 0.65% or 0.7% of the fund size. Trustee custodian fees can be in the range of 15 basis points. Okay. Audit fees are fixed fees depending on the type of engagement that they do. So the fees overall might be about 0.8% to 1% of the fund maximum. Okay. So usually these fees, by the time you see the fund price, those prices that you saw, equal prices that you saw, by the time you see the fund price, the fees are deducted. So all prices that are quoted to you is after deducting fees, expenses, after deducting expenses. Now here, for the lack of a better word, I have used two terms that mean the same thing, but to show two different things, right? So these are expenses that are deducted when arriving at the NAV. So you take your asset value, you deduct your expenses to come up with your NAV. And your NAV divided by the number of units, you come up with the NAV per unit. Then you can have entry fees and exit fees, right? Entry fees and exit fees, sometimes we call them front-end loads and back-end loads. Entry fees and exit fees are charged, like I told you before. These are what changes the fund's unit buying price and selling prices. Expenses do not. Buying prices and selling prices can change between each other if a fund has an entry fee or an exit fee. I told you, funds have exit fees to entice people to stay in the fund. These are some examples, right? So you can see these are actual funds in Sri Lanka, different fees that they charge. Management fees, you can see, ranges from 0.65, 0.5 type of fees. Trustee custodian, 0.11, 0.15 type fees, right? So depending on the fund, depending on how the fund manager bargains, you can have different fees. For equity funds, fees are higher because for equity funds, fund managers do more work than fixed income, right? Because to create a portfolio for you. So you'll see that the fees can be in the range of even 2%. And equity, we have the potential to make very high returns. Like these days, share market is giving you 66% returns. So what's a 2% fee out of 66%, right? So equity funds, because of potential to make higher returns, plus the fact that more than even fixed income, fund managers put a lot more effort in equity. Equity fund fees are higher. Trustee fees, custody fees, but equity funds can have front-end fees and or exit fees. You see here, this equity fund doesn't have a front-end. So every equity fund doesn't need to. Most fixed income funds will not. These equity funds don't have back-end fees. But all exit fees that are there, do you see, are tapering off. They are not there forever. 1% exit fee if less than 1 year. 0% if more than 1 year. 3% if you exit within 1 year. 2% if you exit within 2 years. 1% if you exit within 3 years. Or 0% after 4 years. Why? Your fund manager is trying to entice you to stay inside the fund. Long-term strategies. So exit fees will disappear. Exit fees aren't going to impact you. More, the entry fees and entry fees are there as sales and commission charges, right? So if you have other people or sales forces selling the fund, to entice them to sell the fund, there might be sales and commission charges, which is why you might have entry fees inside these equity funds. Okay. Any questions?
Yeah, performance fee mean that mean according to their sales performances.
So according to, see, this is so this fund in particular, other funds don't have performance fees. This fund has decided to charge a performance fee where it says if you overperform the S&P index. So right now, the S&P index year to date has done 46%, right? I'm putting numbers. It has done somewhere close to
S&P means
46%. The S&P SL20.
S&P means sales and purchasing.
No,
Sales and
S&P,
purchases.
sorry. S&P means Standard and Poor's. Standard and Poor's. So this is a rating
S&P
agency.
means
Standard and Poor's. It's a company. Standard and Poor's. So if you have heard of credit rating agencies, you have Fitch, right? Global credit rating agencies, you have Moody's, you have S&P, Standard and Poor's, right? So S&P does other types of engagement other than credit ratings. One of the types of engagement is they do indices. They construct indexes or indices. And one of the indices they helped us construct in Sri Lanka was the S&P Sri Lanka 20 index. So if you outperform the S&P Sri Lanka, if the fund outperforms the S&P Sri Lanka index, the fund managers are going to charge a 20% over performance fee. So that will work something like this. Let's say the S&P Sri Lanka index right now, the index has moved up by 20%, meaning all the 20 shares inside the index on average has gone up by given investors a 46% return. Right? The fund manager, if the fund manager gave his investors a return higher than 46%, let's say he gave his investors a 56% return, he has overperformed the S&P by 10%. So out of that 10%, he will keep 20%, meaning 2% additional fees he will keep. If he underperforms the index, no fees. So it's an incentive for the fund manager to overperform. And you're better off if the fund manager overperforms the index. Who wins? You win, right? Because if you can overperform 46% and get a higher fee than a higher return than 46%, that's better for you as an investor. So the fund manager says, I will always try to overperform the index, but if I overperform, I will take a performance fee, an additional performance fee of 2% of my overperformance amount, 20% of my overperformance amount. So that's actually in Sri Lanka, you only see this in one fund. Sometimes abroad, you see this happening more. So remember, unit trust funds are there for retail investors. Banks use unit trust funds. Like I told you, private wealth units of foreign banks are not in Sri Lanka. I don't know how it works in Sri Lanka. I can't tell you offhand. But abroad, I have seen where private wealth or private banking units of foreign banks, they offer their clients mutual funds. They offer their clients preferential rates on their deposits, preferential rates on their loans, their private wealth clients, right? But they also offer their clients mutual funds so that the clients have a gamut of services, different services offered to them. This is for the private wealth, high net worth clients. But this is same thing you can offer your clients, offer your retail clients as well. And some banks do that as well. They offer their retail clients also the opportunity to invest in unit trust funds, where you work together with a fund management company. And obviously, if the bank is promoting the unit trust fund, that means the bank is getting some sort of fee arrangement from promoting the unit trust fund, right? But you are now offering, just like you're offering insurance products, you're offering different types of services to your clients. So, and either personally or to your clients, you should always think about what is your investment goal. Depending on what your investment goal is, if you just want to preserve your capital, you can just invest in money market funds. But if you want to generate an income, invest long term and look at wealth generation, then you should be looking at equity funds, bond funds, balance funds, right? So income funds, gilt edge funds, equity funds, balance funds. This is where you can really think about long-term appreciation. Not that these won't much more than that. If you want to save for your retirement, save for save for increasing your wealth, you have to think about investing in long tenor instruments that will beat inflation. And you don't have to go through a unit trust fund for this. This is true for direct investments also. Investing in the share market will help you beat inflation, right? Investing in the bond market will help you beat inflation and grow your wealth. But investing in the share market, if you are comfortable investing in the share market on your own without professional advice, you can do it on your own. Investing in the bond market is not so easily accessible to individuals, which is where unit trust funds type of investments become handy, for lack of a better word, become useful as an investment alternative.
Is that for the point of the customer, no?
Yes, from point of your view or from point of customer's view.
Excuse me, madam.
Just go ahead.
We didn't get the last session's tute, I think, the investment banking one.
You didn't? I sent that across. I was late in sending it across actually, so I was at fault. I was a little late in sending it across, but I have sent it across. So just remind them they're distributed.
Okay.
So things to look out for when you're thinking about investing in a unit trust fund. Look at the fees that are being charged by the fund. Look at the track record of the fund management team. The size of the fund. Do you want to invest in a 30 billion fund, or a 100 million fund? Because a 30 billion fund will have more liquidity, more options, right? So the size of the fund gives you an idea of the liquidity that's available in the fund. What has been the fund's past performance? Has the past performance been consistent? These are different things that you will look at when you're thinking about investing and trying to figure out what unit trust fund. After you figured out where you want to invest, what's your goal, to choose the fund, you will think about these different things. So in Sri Lanka, unit trust funds are a very small business, right? Unit trust funds are there for retail investors, but Sri Lanka is yet to grow their unit trust industry. If you look at banks in Sri Lanka are a 13 trillion rupee industry. You see? Licensed commercial banks, 12.8 trillion. This is 2020 numbers. Okay. 13 trillion rupee industry, assets in the banking sector. Look at insurance funds. Insurance companies are, look at finance companies, 1.3 trillion assets. Insurance companies, 790 billion assets. EPF, 2.8 trillion assets. Unit trust funds, 200 billion assets. Do you see how small the industry is still? The industry has grown, but it's still extremely small. So it's still yet to reach that potential that is there. And part of the reason is actually when you see this industry growing, most of this growth still comes from people investing in money market funds. This is why I keep telling you, money market funds are a good alternative. There's nothing wrong with investing in money market funds, but if you are investing in funds as a point of investing in your wealth, right, increasing your wealth, you have to look at long-term investments. So the industry has grown mainly because people have started understanding money market funds. But really, for Sri Lanka to grow, for Sri Lanka, for our people to increase their wealth, you have to think about long-term investment, okay, which is share market, which is bond market, which is fixed income, long-term fixed income. So we have right now 16 different unit trust fund management companies. I showed you the website, which will give you a lot of details. The Unit Trust Association of Sri Lanka, utasl.com. This website gives you all the details of like the different unit trusts. We have about 80 different unit trusts catered to by 16 different fund management companies in Sri Lanka. All of them are open-ended funds. We don't have any closed-end funds right now. We do have money market funds, income funds, gilt-edge funds, balance funds, growth funds, Sharia-compliant money markets funds, Sharia-compliant equity funds, Sharia-compliant income funds, right? So we have index funds, sector funds. Did I capture everything? Yeah, I think so. We have all these different types of funds. So a gamut of investment opportunities are available. It's up to the investor to pick. Okay.
Is this investments companies all are under the central bank or license companies?
They are under the SEC, Securities Exchange Commission.
Securities.
Oops, sorry. Securities Exchange Commission. So unit trust funds come under the purview of the SEC.
What are the barriers for the private banks to come for that market?
What are the barriers for private banks to start a unit trust fund?
Yeah.
Is that what you're asking? No, there is no barriers. Actually, if you look at, so some of these companies, now these are in alphabetical order, right? Look, you have CBank.
NDB Wealth Management is there.
NDB Wealth Management is a subsidiary of NDB Bank. CBank is a subsidiary of Bank of Ceylon. Nama, currently a subsidiary of Union Bank. Yeah. So you do have subsidiaries of banks operating unit trust funds. So there is no restriction. There is no barrier for a bank to offer or operate a unit trust company. Okay, so that finishes that section. I will. Oh, so you have a question? Tyagaraja? You asked a question? There is a hand raised. Okay. I assume the question is asked. Okay, so I will send this presentation across as well, and you can ask both presentations together. Yeah, that finishes that area. If you have, do you all have any other questions? Okay, thanks a lot. We'll stop at that point.